Norway is a small country with a population of just over 5 million people. But despite its size, Norway owns shares in thousands of companies all around the world, including many of the biggest businesses you've probably heard of. Companies like Apple, Microsoft, Google, Nestle, Shell, and thousands more. Norway isn't doing this because it's trying to control global markets, and it's not because it's taking risky bets or chasing fast profits. It owns these companies because of one of the most disciplined long-term investing strategies ever created. To understand how Norway ended up owning a piece of almost every major company, you have to go back to where the money came from. For much of its history, Norway was not a particularly wealthy country. Its economy was based on fishing, shipping, and natural resources. That changed in the late 1960s, when large oil and gas reserves were discovered in the North Sea. Almost overnight, Norway had access to enormous amounts of money. This is where many countries run into problems. When governments discover valuable natural resources, they often spend the money quickly, rely on it too heavily, or use it to fund short-term growth. This is sometimes referred to as the resource curse. Norway chose a different path. Instead of spending all the oil revenue immediately, the government made a long-term decision. The wealth generated from oil should benefit not just the current generation, but future generations as well. So rather than injecting all of the oil money into the economy, Norway created a separate fund designed to save and invest that wealth over time. That fund is known as the Government Pension Fund Global. Despite the name, it isn't a pension fund in the traditional sense. It doesn't pay pensions directly to citizens. Instead, it acts as a national savings account for the country as a whole. Today, it's the largest sovereign wealth fund in the world, worth well over $1 trillion. What's more interesting than its size is how it invests. The fund doesn't try to pick winning stocks, beat the market, or make bold predictions about the future. Instead, it invests broadly across global markets, owning small pieces of thousands of companies in dozens of countries. This is how Norway ended up owning a slice of almost every major publicly traded company. Around 70% of the fund is invested in global stocks. Not just Norwegian companies and not just European ones, but businesses across the United States, Asia, emerging markets, and beyond. The rest of the fund is spread across bonds, real estate, and other assets, but stocks form the core of the strategy. Rather than concentrating its money in a few areas, the fund focuses heavily on diversification. It spreads its investments across industries, sectors, and regions so that no single company or market can significantly damage the overall portfolio. Another key part of the strategy is time. The fund is built with a very long-term mindset. It isn't concerned with short-term market drops, quarterly earnings, or daily price movements. It's designed to hold investments for decades. Because of this, market volatility isn't something the fund tries to avoid. It's something the fund expects and plans for. When markets fall, the fund doesn't panic. When markets rise, it doesn't chase performance. Everything follows a set of predefined rules. This deliberate lack of excitement is one of the most important reasons for its success. Norway's investment strategy is intentionally boring. The fund doesn't chase hype, speculate on trends, or constantly adjust its approach. Instead, it follows a clear framework that determines how much is invested in stocks, how much is invested in bonds, and how the portfolio is rebalanced over time. By relying on rules rather than emotions, the fund avoids one of the biggest causes of poor investment performance: emotional decision-making. Another thing that sets Norway's fund apart is transparency. The fund regularly publishes information about what it owns, how it votes at shareholder meetings, and how it manages risk. This level of openness is unusual, especially for a fund of this size. It also follows ethical guidelines, avoiding certain companies and industries based on environmental, social, and governance standards. These decisions aren't about chasing trends. They're about maintaining consistency and discipline over the long term. The result of all this is a fund that quietly owns small portions of thousands of companies across the world. No dramatic headlines, no aggressive trading, just steady, patient investing. Most people watching this will never manage a trillion-dollar investment fund. But the lessons from Norway's approach still apply to individual investors. The most important takeaway isn't which stocks Norway owns. It's how it thinks about investing. Norway shows that diversification matters more than finding the perfect stock. That long-term thinking beats short-term predictions. That simple, rule-based strategies reduce mistakes. And that consistency is more important than excitement. Norway didn't build its wealth by trying to be smarter than everyone else. It built it by being patient, disciplined, and realistic about how markets actually work. Owning a piece of almost every company wasn't the goal. It was the result of a strategy focused on time, diversification, and restraint. Norway took a temporary resource, oil, and turned it into a permanent source of national wealth by investing calmly and consistently. For anyone new to investing, that's a powerful reminder. Successful investing doesn't need to be exciting. It doesn't need constant action. It just needs a plan, patience, and the ability to stick with it over time. If you want more calm, beginner-friendly explanations of how investing really works, that's what this channel is about. Thanks for watching.